I'm Motley Fool Canada senior analyst Nick Sciple, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're asking the question everybody is thinking: is now the time to invest in Canadian stocks? My guest today is Motley Fool Canada Chief Investment Officer Iain Butler. Iain, thanks for joining me.
Great to be here, Nick. It's been a couple weeks since we've done one of these, so excited to get back at it.
I'm excited to be here with you, Iain. According to a Bank of America note released this week, TSX stocks today trade at their steepest ever discount to the U.S. S&P 500 benchmark, driven by tariff fears and just overall uncertainty in the economy today. Iain, is now the time to invest in Canada, in your opinion?
Well, I'm a bit biased. As someone that spent the bulk of their career snooping around the Canadian market for stock ideas, I can say that now is always the time to invest in Canadian companies. But sometimes certainly are better than others. And from an index standpoint, as you mentioned, Nick, the Canadian market is looking especially appealing relative to the top-heavy U.S. market these days. Top heavy is key there. Because a big reason for this is just how the U.S. market has evolved over the past decade or so. So when I started with the Fool back in 2012. It was remarkable, despite vastly different compositions, how closely the S&P TSX Composite and the S&P 500 had performed over the long term. And by long term, I'm talking 30 years or so. Over the past decade, however, the S&P 500 has just turned on the gas. Turbo boost, really. It's tripled the performance of the Canadian market, blowing that long-term track record right out of the water. And a lot of that outperformance has been largely attributed to one sector, and that is technology. U.S. market has a technology sector, Canadian market does not. This has really changed the composition of the U.S. market. And again, when I started with the Fool, one of the primary reasons to invest in the U.S. market was because of just how diversified it was relative to the Canadian index. Top three sectors of the U.S. accounted for about 48% of the S&P 500, whereas the top three sectors in the Canadian market, namely energy, financials, and materials, totaled about 72%. So when you bought Canadian, you were buying three sectors. When you bought the U.S., you're buying a more diversified basket. Today, however, technology makes up 31% of the S&P 500, and that's more than double of the next largest sector, which is financials, at 14% in the U.S. Canadian market is still concentrated. Financials and energy continue to dominate, less so materials because it's been a bit of a lost decade there. But the three now account for 61.5% of our market versus 72% a decade or so ago. So when we're considering the two markets, again, Canadian market remains somewhat concentrated, but the U.S. market has really come down to a play on the technology sector.
Yeah, if you look at the U.S. market, it's really become the popular place to invest, not just for U.S. investors, but investors around the world, has really pushed up those valuations. By contrast, Canadian market hasn't seen those type of global inflows, which maybe has created some opportunities in those less followed companies. So, Iain, that brings us to the next question. What is one Canadian stock on your radar right now that you think is not getting the love it deserves?
Totally, and I think we can put these into a couple buckets. Actually, I think small cap Canadian companies are being very much ignored, as are dividend-paying companies. And we've got one that actually combines the two qualities into one here. So a tiny little company by the name of Amerigo Resources, ticker symbol is ARG on the TSX. This is a company that is essentially a copper factory. They own a factory that sits adjacent to one of the world's largest underground copper mine in Chile. And this factory just processes the tailings from this mine. In go the tailings, which are essentially the discarded dirt from the mine, and out comes processed copper that is inconsequential to Codelco, the owner of the mine, but very much material to Amerigo. So Amerigo is very sensitive to the price of copper. When copper does well, Amerigo does really well. They just released their 2024 fourth quarter and full year results. This is a free cash flow printing machine when the price of copper is essentially over $3.50 a pound. So $50 million in free cash flow during 2024. That's against a market cap of $300 million. And they have very little to do with that cash. They pay a dividend, they pay special dividends, and they buy back shares, and they're going to be debt-free by the end of 2025, which means they'll have even more cash to give back to shareholders. So tiny company, dividend payer, two areas that I think are very attractive in the Canadian market, and a resource play that you just can't really necessarily find when you're shopping south of the border, which is filled with all the giant technology companies of the world.
Yeah, so in an environment where all eyes are on the U.S., there's one example of an underfollowed Canadian company we think offers some value for you today. Iain, thanks so much for joining us for this edition of the 5 Minute Major. We hope to see everybody next time.